Hey, this is Dan, and I run Long Mountain Family Banking. And I want to do just a short video showing you how you can truly protect your savings. When you get a paycheck, it goes straight through the bank, mostly to expenses. Hopefully, you're able to save a little bit, but you'll find that those savings end up becoming long-term expenses. You fill it up and then it just drains down and you just keep going up and down, right? And so I'm going to show you how you can create a compound growth curve that will grow for your entire life and will create a family banking system whereby now your family is taken care of in the future. The money stays in the family. And what you have essentially done is you have protected your savings from any expenses that you might have. Let me show you how to do it. Let's get into it. When you get your paycheck, what do you do with it? So there you have your paycheck. From there, most people put it into a traditional bank. And very quickly, it goes to their expenses, or maybe to some savings as well, hopefully. And so now we have these two categories. Now, one of the hard things about savings that makes it difficult to keep our savings protected is that we have something like this occurring, where we're saving up money, but then something comes, maybe a car expense, then we try again. Oh, we had an emergency where we needed to plunge into our savings, or maybe we want to even, buy a tractor. Okay. So if you think about it, these are just delayed expenses. It's a long-term expense, where here we have short-term, and right here we have long-term expenses. Okay. But if you think about it, they're both expenses. Okay. And the problem here is that we have to keep on starting over. Okay. And I think you can see that in order to make our savings successful, in order to protect our savings, we have to separate the savings from the expenses. How do we separate these? If we can disconnect these two items from each other, then we might be able to actually keep our savings. So let's do that. Let me show you a way to create a family banking system and protect your savings. Okay. So let's take these savings, let's bring them over here and put our money, instead of into a traditional bank, let's put it into a life insurance company by starting a whole life insurance contract. Got it? I'm going to separate these into two pieces so you can better understand how this is going to work. Now, as soon as you put your money into a life insurance contract, they call it premium. That premium buys you now a death benefit that is secured, that even if you were to die the next day, that amount of death benefit would go to your family. These could be very large amounts. Income tax free, by the way. And so we have now secured a death benefit for our family. And with that death benefit, within this contract, there's another component that you need to know about called cash value. Cash value is kind of like the equity of the policy itself. It's the net present value of the death benefit, what it is worth today. And what that cash value allows you to do, well, you could surrender the policy and get that amount back to you. But you can also, a better way is to borrow, what they say, borrow against it. This acts as a collateral from which you can now borrow funds from the insurance company. They have a general pool by which you have a contractual right to borrow. By the way, the only questions they really ask you when you want to borrow is how much money up to is how much is available, with the cash value, only as much as the cash value allows. How much money and where do you want it sent? Okay, do you want it in or a check or a cash, right? Okay, so that's pretty cool. Okay, there's no qualifying. You have contractual right to borrow, and the payback schedule is on your terms. Okay, let's move on. When you create a life insurance whole life policy, you have now, like I said, secured the death benefit, and you have introduced a compound growth curve that does not get interrupted. As you can go see, our savings back here would get interrupted by expenses. If you need an expense, then what we can do, let's drag this over here, and we'll split these two things up into the savings. Here's the savings, right? And here's the expenses. We're going to separate the two. And now you can see that I have disconnected the long-term expenses from the savings, okay? Now what that allows this to do is it allows this to keep on growing. It's truly protected. That's the point. The savings now is truly protected from interruption, and the compound curve will keep on growing throughout the entire life of the contract, which is to your death, right? So long-term expenses. So now let's say you want to buy your tractor. So let's do a tractor let's say you buy a really nice tractor, and you've paid premium into this policy, right? You've been putting your money into it. Instead of putting it into your savings over here, you're putting it over here, you're building it up. You have $30,000, okay? Cool. And let's say that the savings only grows at 4%. Okay. And we're going to do this for 5 years. Okay. And this, we're going to say that you have to, in order to do this, there's a cost, okay, to borrowing from the insurance company. And that cost is in the form of interest. And most of the going rates around right now are between 5 and 6%. So let's go with 6%. And let's say for 5 years, you're borrowing to buy this tractor. Okay. Now, $30,000 at 6%, 5 years. Okay. Do you know how much you're going to be paying if you amortize this cost of interest over 5 years? You are going to be paying in total over the 5 years of 34,799. If you're saving this money, your savings, however, is only growing at 4% for 5 years, do you know how much you're going to have? The total comes to 36,499. Wow. So that's interesting. I was borrowing at 6%, collateralizing against my cash value savings, but not touching the savings. And I'm only earning 4%, which is over the lifetime of a whole life insurance policy over all those years, it ends up being somewhere around 4%. So this is a good example. You end up, how is it that I end up with more? And the reason is because it's the magic of compounding. You're earning on an ever increasing balance. Over here, you're paying interest and principal back on an ever decreasing balance. Got it? And so does this system work? Even with paying for long-term expenses, when you need it, do you still end up ahead? Yeah. And now you've protected your savings. You started a family banking system whereby now your family is secured a death benefit. You can go and finance things like tractors. You can pay for emergencies and car expenses. You just keep pouring this money through the life insurance into the life insurance contract that you created with the life insurance company. And when you need money, you just take a simple loan out and pay it back, and you fill it back up and go do it again. It's pretty simple. But you can see how I needed to disconnect the savings from the long-term expenses, and that's what we just did. We put the savings, locked it in over here, and then just borrowed against it when we needed to pay for those expenses. And now your savings are preserved and protected and will one day be passed along to your family. Pretty cool, huh?